Hey everyone, let's talk about large cap funds, the big dogs of the stock market. But instead of a boring textbook definition, we're going to zero in on one fund that's just been crushing it. A fund that seems to be playing by a whole different set of rules. So, how did they do it? Let's dive in.
I mean, you see a headline like this, and your first thought is probably, okay, what's the catch, right? Is this just clickbait? In a field full of giants, how does one single fund manage to pull so far ahead of everyone else? Well, that's exactly what we're going to unravel today.
And look, the numbers really tell the story here. Over the past 5 years, the Nippon India Large Cap Fund has pulled in an average return of, get this, 21.46% every single year. Now, put that next to the average for all other large cap funds, which is just over 15%. That isn't just a little better. That's a huge, massive gap. We're talking about a serious outperformance.
So it all boils down to this, right? What is this fund's secret sauce? What are they doing that nobody else is? And maybe even more important for you and me, what can we learn from their success about investing in these market giants?
Okay, first things first. Before we can really appreciate why this fund is such a winner, we've got to understand the playing field. So let's do a quick breakdown of what large cap investing is all about.
So here's the number one rule of the game, straight from SEBI, India's market regulator. It's super clear. A large cap fund has to invest at least 80% of its cash in the top 100 biggest companies in the country by market cap. Yeah, we're talking about the absolute titans, the names you know and see every single day.
Here's a simple way to think about it. The large caps, they're the stable giants in your portfolio. Think of them as marathon runners. They're steady, they're reliable, and they're built for the long haul. Now, mid and small caps, they're the total opposite. They're the explosive sprinters. They could give you these incredible bursts of growth for sure, but they also come with a whole lot more risk and, a much bumpier ride.
All right, so we've got the lay of the land, we know the rules of the game. Now it's time for the main event. Let's pop the hood on the Nippon India Large Cap Fund and really see what makes this thing tick. So this is where the fund is placing its biggest bets. You can see it's heavily overweight in financial services. That just means they're putting way more money there compared to the average fund. And that sector makes up a massive slice of their pie. They're also making big plays in consumer sectors and industrials. Believe me, none of this is by accident. These are very deliberate, very strategic choices.
And if we look at the individual stocks, here are the star players on the team. You're not going to be surprised to see names like HDFC Bank or Reliance up top. But what's really interesting is the concentration. They have almost 10% of the entire fund in just one stock, HDFC Bank. And you can see they're leaning heavily into the banking sector as a whole. That tells you they have some serious conviction in their top picks.
Behind every winning team, there's a great coach, right? Well, meet the fund manager, Silas Rajban. His philosophy is so simple, but so powerful. He basically says, don't overpay for growth. In other words, don't just chase the hot, hyped-up stocks. The price you pay at the very beginning, that's what's going to determine your real returns in the long run.
And here's a perfect example of how they put that philosophy into practice. Remember back between 2018 and 2020, the whole market was just obsessed with a few super expensive quality stocks. Well, this fund, they went bargain hunting somewhere else. They started buying into really high quality but totally ignored sectors. Think manufacturing and engineering. These were companies getting a boost from things like the Make in India initiative. It was a classic contrarian move, and boy, did it pay off.
Okay, so we've seen how one fund can totally crush it, but let's zoom out for a second. What does all this mean for you, the investor? See, when it comes to large caps, there's always a trade-off. It's like a coin with two sides, and you really, really need to understand both. So on the one hand, you've got all the good stuff that comes with these stable giants. We're talking about companies with proven track records, which usually means more reliable, predictable growth. Their stocks are traded like crazy, so it's super easy to buy and sell them. That's what we call high liquidity. And here's the big one. They tend to hold up much better when the economy takes a nosedive.
But there's always a but, isn't there? There's a price you pay for all that safety and stability. For one, these companies are already huge. Their days of explosive 10 times your money growth probably over. And let's be clear, they are definitely not crash-proof. If the whole market tanks, they're going down too. Plus, when the market is booming, a real bull run, they can actually get left in the dust by those quicker mid and small cap stocks.
Okay, we've talked about the what, the how, and the why. But now we get to the single most important question of all. What does this mean for your portfolio? Is a large cap fund the right move for your financial goals?
And really, this is where you need to take a second and think about your own situation. What are your goals? How long are you investing for? And honestly, how much risk can you stomach? Because the answer is definitely not going to be the same for everybody.
But as a general rule, large cap funds are an awesome fit for a couple of different kinds of investors. First up, beginners. If you're just dipping your toes into the stock market, they're a great, less scary way to start. And second, pretty much any long-term investor who wants to build a solid, stable foundation for their portfolio before they go chasing after riskier bets. And listen, when we say long-term, we really mean it. The stock market goes up, it goes down, it moves in cycles. To really see the benefits, you've got to be willing to stay in the game for at least 5, maybe 7 years. That gives you enough time to ride out the inevitable bumps and let that beautiful magic of compounding, where your returns start earning their own returns, really kick in.
So how much should you have? Well, a pretty common rule of thumb from financial advisors is that large cap funds should be the anchor of your equity portfolio. Think somewhere in the ballpark of 40 to 60% of all your stock investments. They're the solid base that lets you feel comfortable taking a few more calculated risks with the rest of your money. So in the end, it all comes back to you and your plan. The biggest thing to take away from all this is just understanding the job of each investment. Are you trying to build your foundation with the slow and steady power of a giant? Or are you looking to juice your returns with an explosive sprinter? Of course, the smartest portfolios, well, they usually find a clever way to use a little bit of both. Thanks for tuning in.